The worst question when it comes to investing. It's weekend, so we're talking about investments and financial education. What's the worst question when it comes to investing? I was sitting and thinking what it is. Dear ones, we are the business team, and today we present you with the worst question when it comes to investments. Stay until the end. Disclaimer: I'm not a financial consultant. When do I take my money? This is the worst question when it comes to investing, and I always remember this question. It is clear that you do not understand what the concept of investment means. Investments are that money to become productive on its own. Investment is not and does not mean trade. The trade is when you take apples at $1 kilograms and sell it at $1.30 kilograms. You took your money and made a profit. Investments are not the same as trade and people mix them. Investments are when you have what can I do with this money? Well, you must put this money to work for yourself, because otherwise it will devalue due to inflation. You invest your money in various things. And here comes the performance, the percentage that we all follow. And the results of the investments differ first and foremost from how long you want to link to those investments. Let's give an example. There are active investments. You have $10,000 to put into a business, but that business takes time. You must dedicate yourself to the business for that business to work. And then your investment can be tremendously increased. Let's say you put them in a coffee shop, and that coffee shop brings you $1,000 a month. Then it means you have $12,000 a year. So you have a 120% performance, but you worked every day at that coffee shop. Or you can put them in the bank in a savings account, which is a pretty bad investment. And then, let's say the bank offers you 1 or 2%. 1% vs 120% yes. But here you worked every day. Here not at all. You didn't work here at all. What we need to look for when making these investments is to see first of all how much extra time we have. This is the first criterion you must follow. How much time do you have to take care of that investment? If you have an hour, you say, yes, I work. I don't have time. Then you must go for investments that are in the area of liabilities, which you just put some money in there and leave it there. This can be translated into the stock exchange. For example, you can invest in an ETF, in an index S&P, in NASDAQ, and you can check the portfolio in a few years. You are not interested at first because you did absolutely nothing. In a while, you will see that you have a profit of 10%, 20, 30, 50%, and that makes you happy because you see that you have a profit. And it was worth your patience. That makes you happy because you don't work at all. Then there are the semi-active investments in which you practically do something. Example: flip to real estate. Let's say you want to buy an apartment. It costs $60,000. Maybe you'll take care of him, give him a cousin, maybe change his furniture. You put another $5,000 in it, hoping that you will give it $70,000, $80,000. This is a kind of trade, but at the same time an investment, because you practically didn't do much. You made an announcement. You made the documents. You didn't work on building that apartment. You just did a pretty slow trade. Because it's not a daily trade. Today I am selling an apartment. Tomorrow one? You bought an apartment and in a few months you sold it and then you made a plus, and on that money you invested, you made 20% in 6 months. And it can be a semi-active option to invest. Then on the stock exchange you have the same equivalent as swing trading when you make medium-term investments. Let's say you buy Netflix or any stocks in a support period. If it grows to a period of resistance, then sell it. You made, say, 10, 15, 20% in an interval of a month, 2 months, and then you start over, and you do it again. But for that, it requires, again, the search work to find the best investments, trades, and so on. To diversify your portfolio, to constantly document yourself, so it takes you time. This is the first thing you need to start from. And then you must see what your risk tolerance is, because, practically, investments are of several kinds. But the higher the reward, the higher the risk. Same with the coffee shop. I invest $10,000, but the risk is very high. Most newly established companies go bankrupt in the first 2 years, so the probability that the business will not work is very high, and the probability of success is very low. and then the probability of substantial profit is even lower. Basically, you have a less than 10% chance that that company will stay afloat even after 2 years, and you will still make something out of that investment. The risk is very high, but if it works, it is possible to bring you 100–200% profit maybe every year based on that investment, and can ensure a constant, stable income based on that investment. But I repeat, the risk is quite high. Instead, you can invest in an ETF, for example, which gathers 50 clean energy companies or 10 top clean energy companies, and automatically, this is a growing field in that you have suddenly invested in 10, 20, 50 companies, or you are investing in an index. In this way, the risk is very low that all those companies go bankrupt, and you lose all your money. Yes, there is a risk of losing your money when it is a nasty, unfavorable period, when everything has gone down. But if you don't sell, it's not a loss. This is called unrealized loss. But if you wait long enough, that decline will stop and the index will take it uphill. So you must ask yourself what your risk tolerance is. Are you willing to lose all your money? Is that money important to you? You really must take these things seriously, because you can say that this money doesn't matter, but then, if you see that they have a 10–15% drop, you're still panicking, and you don't know what to do. In this situation, it is good to create more portfolios depending on the degree of risk. Another investment is cryptocurrencies. You want to invest, say, in a cryptocurrency that is volatile, and you think that maybe it will grow now, during this period. It is important to see the fundamentals behind this virtual currency and to invest only the money you can lose. It is very important to understand what you put your money into every time. To avoid being disappointed and losing money without knowing why this happened, understand what you put your money into. I'm not telling you to put money into anything, but if you decide to invest in something, it would be good to understand that investment by heart. If you invest in a cryptocurrency, you need to know why you put money into that cryptocurrency. If you choose to invest in a company, you need to understand why. For example, I want to invest in Netflix because I saw that they have high sales, that they deliver the promised movies and series, etc., and I consider that it has some good fundamentals. Under no circumstances invest because someone told you to invest without understanding. Even if someone calls you or comes to you and tells you that he has a tip to invest, always ask the question, why? Why invest? Make me understand. Why do you think if I invest, I will make money? If that explanation makes sense to me and sounds like a good opportunity, I re-verify the information and tell him, wait a minute, and I'll read that maybe you read in vain. If the information is confirmed, then, yes, I invest too, otherwise not. And these things will generally save you from a very big loss. I hope this video helped you, and I want you to make the right decisions when you decide to invest. Don't forget to like and subscribe, and we'll see you in the next video.